Hi friends, we launched currency derivatives 4 years back and we saw tremendous response and support from all of you. Today I am here to talk about one more interesting product and looking for the same support and response what we saw in currency from all of you. We all know there are 4 major asset classes which gets traded on exchanges. It is equity, commodity and currencies. Today I am going to talk about the fourth one which has just got recently launched in India. It is interest rate futures. I am sure you may not have too much of an idea about how it works. I will take you through the session. To the surprise of everyone, interest rate futures is the most traded futures contract in the world. In fact, it is more than even the currencies, equities and commodities put together. If we look at the average daily volume of interest rate futures across all exchanges put together, it comes to approximately around $7 to $8 trillion a day. I will take you through the contract which has just recently got launched on interest rate futures, what we can do with it, which all are sort of clients which we can tap, we can talk about. So today I will basically talk about how this contract is going to work, which sort of clients we need to look at it, and how it can be helpful in our overall of services which we offer to the clients. So what is our view on interest rates? So how our clients can take a directional view or they can hedge their debt portfolio. So it can only be possible through interest rate futures. We all know that today, if in case any client wants to take any view on the interest rate, he doesn't have any product or a hedging mechanism through which he can take care of his bond portfolio risk. So interest rate future is one contract which can take care of the bond portfolio risk, as well as if in case they want to take view on the interest rate, they can do so. We have seen recently interest rate futures getting launched on MCX, NSE followed by BSE. It is just 1 week. We have seen on first day a very good response from the market. Approximately we saw around 3,000 to 3,500 crores of daily volume on both the exchanges put together. It is not that interest rate futures is getting launched in India for the first time. In fact, it is the 4th time interest rate futures is getting launched. For the first time it was launched in 2003, followed by 2009, then in 2011, and now we in 2014. So why we are this time slightly bullish that this product is going to see the light of the day or will be well accepted in the market? There are basically 2 reasons for it. In fact, in earlier formats, whenever interest rate futures were launched, I mean they were deliverable in nature, and it was against a basket of securities. And considering that Indian bond market is not so well developed, it was very difficult for individuals and common investor to understand how bond works actually. So in order to make this product successful, what the regulator RBI and SEBI has done, they have make the contract cash settled, as well as they have kept the underlying as a single bond. So they have removed the basket of securities as a deliverable, which in earlier formats could be possible. So what is interest rate futures? We all know that derivative contract has to have an underlying. So in this case, the underlying is 10-year Government of India bond. We have seen 2 kind of contracts getting launched under the IRF segment. One is 883 10-year Government of India bond and 716 10-year Government of India bond. Basically 883 is right now on the run Government of India bond, which is what we call also as the benchmark bond, and second is off the run, just got out of the benchmark. So if in case any of your clients wants to take a view on interest rate, how they can do so? It is only possible now in India through interest rate futures. We have just seen the monetary policy from RBI. So if any of your clients wants to have a view that interest rate is likely to go up, so what they need to do? They can take a price view on the interest rates or the monetary policy from RBI through interest rate futures. The one important thing which we have to keep in mind is here that the bond yield and the price, they behave inversely to each other. So if in case we expect the interest rates to go up, we have to sell the futures contract and vice versa. So if in case you expect the interest rates to soften or to be reduced by the Government of India, RBI, then we have to buy the interest rate futures. Now coming back to the interest rate futures, I will talk about the contract specification. So each contract size is of 2 lakh face value, equivalent to face value bond, and the margin requirement in bond is between 2.5 to 3%. So it is quite convenient for anyone to trade in interest rate futures. The underlying volatility usually what we have seen is between 0.5 to 1%. I mean, the expiry date here is the last Thursday of every month. So same as what we see in equity futures. So who can be our target clients here? Basically our target clients can be the individuals who want to take a price view on interest rate movement in India. Second, could be those HNI clients who have bond portfolio in their book and they want to hedge their interest rate risk. Since the product is new in the market, we can take advantage of being the first mover. We still see that our peers are not really up on the curve in terms of offering this product. We already have infrastructure in place, and the best advantage here what I see is that exchanges have kept the transaction charges zero for the time being till the time the contract becomes very liquid. There is no STT as well. So the only cost which a client incurs in trading in interest rate future is basically the brokerage what they have to give and whatever is the stamp duty applicable. Now we have kept the brokerage around 2000 rupees per crore, and depending upon the client size and volume we can always look at what we can offer. We have kept the brokerages at 2000 rupees per crore for individual clients, and depending upon the volume and the capacity of the client, we can always have a relook at the brokerages, because the underlying volatility in this product is going to be lower. Before I wrap up, I want to emphasize upon two things: that bond yields and prices are inversely related. Unlike in equity, where if in case we see Reliance prices are going up, we need to go long, here it is different. So if our expectation is that the bond yields are going to go up or interest rates are going to go up, the prices are going to move inversely to that. So bond yields and prices are inversely related to each other. Second is that benchmark bond keeps changing at an interval of 6 to 7 months. So it is not necessary that we are going to see the same benchmark all the time. Presently we have 883 as our benchmark. It may happen so that 2 months, 3 months down the line the benchmark may change. So accordingly there will be a change in the contract as well in the IRF segment. I am expecting that we will see the same support which we saw in currency derivatives, and I am looking forward to that. For any queries you can always call me up, I am available, and or you can always send me an email. We are also going to put up a similar presentation on IRF in our CRISP, so that you can always refer back to that. Thanks a lot.